Hey everybody, my name is Cameron Dennis. I'll be interviewing this wonderful panel today about the future of decentralized compute. Just a little bit of background on myself before we get going is I've been building the Near ecosystem for about 4 years and crypto for about 8. Right now I'm working on Near AI to help stand up the ecosystem, sort of different parts of the whole stack. So these guys are all focused on the compute layer in some way, shape, or form, or decentralized inference. And so really excited for the panel today. I think these are some of the best guests that we could have brought. And so just to kick things off, would love to start with a quick round of intros. So Matthew, you want to go first?
Sounds good. First of all, thanks for having me. I'm Matthew, one of the co-founders of OpenGradient. Prior to starting OpenGradient, I was a research engineer working on quantitative modeling and engineering for an equity options trading desk at 2 Sigma, which is a quant fund based in New York. I guess just a little bit more context. I started getting into DeFi, was fascinated by what Web3 could offer, but we realized that there were no out-of-the-box solutions that would allow people to host or integrate AI or ML compute directly into their applications and empower these applications with more expressive forms of computation. And that's what kind of informed the initial vision behind OpenGradient, which is to build something where people can just like drag and drop, upload their models, and inference it securely within their smart contract directly.
Awesome, thank you. Thank you for having me as well. My name is Mathilda. I'm currently the head of strategy at Gaib. My background is a bit more on the VC side. So I started off at Binance Labs, the VC arm of Binance, spent about 2 years there, did a bunch of deals, and then always wanted to move on to the operator side, and here I am. At Gaib, what we're trying to build is the economic and financial layer of computational assets, particularly GPU. So you all know that there's already super high demand for professional grade GPUs right now in the real world, in the off-chain world, and the demand is only getting bigger and bigger. So these cloud and data center, what they've started to do right now is to collateralize their GPUs with asset managers like Blackstone, for example, to borrow out loans and use that borrowed funds to buy more GPUs and scale their business. So what we're trying to do is essentially bringing these kind of deals on-chain with tokenizing loans backed by GPUs or the future cash flow of GPUs so that cloud and data center can get funding in an easier way. And investors, no matter retail or crypto whales or institutions, can invest in a new type of yield-bearing assets. Yeah, that's about it.
Yeah, I think it's really cool. I just like the idea of actually being able to invest in the infrastructure layer, right? We can't go and buy AWS shares, right? You can't buy Google Cloud shares, right? Your ability to actually invest into that infrastructure stack as a retail consumer is pretty limited, to be honest, right? You either go NVIDIA or something kind of smaller, but you really can't kind of hit the cloud stack very effectively as a retail buyer. But yeah, Mark here from Aetheir. We build decentralized GPU infrastructure for AI and gaming companies. You can think of us like kind of an AWS, but the difference being we're entirely GPU focused. We're 100% enterprise grade, right? A lot of DeepIn is kind of built on consumer contribution. We're not a consumer grade ecosystem. Everything in our network is enterprise grade, sitting in a data center or connected to enterprise-grade network infrastructure. But yeah, we like to think that we're making it easier for builders in the AI space to access critical resources that they need to build cool stuff.
And just a quick question for you, Mark. The builders in the AI space, I've talked to a ton of them, all the big research labs, independent founders. A lot of them are a little bit skeptical about this whole decentralized compute market. They think it's riddled with low latency, it's not incredible uptime. How do you guys address this?
I mean, the first challenge, or the first thing that you kind of need to look at, right, is you have to have enterprise-grade SLAs to serve the vast majority of companies that are looking to engage with your infrastructure, right? Which is why you can't build a network on the back of consumer equipment, right? Because you cannot guarantee that a gaming PC is going to be, kept on at night, right? Maybe the RGB stops you sleeping, right? You can't hit enterprise-grade SLAs with consumer equipment. So first of all, if you're going to be serving that type of customer that cares about that type of thing, then you're going to be needing to kind of limit what contributes to your network in a way that ensures that you can kind of maintain those SLAs. I think the other, I guess, challenge you mentioned, like latency, right? People, we educate our community and hopefully the broader community that decentralized doesn't necessarily mean not co-located, right? A big concern in the AI space when you're training or even running inferencing is how effective is the communication between all of the GPUs doing the work in your ecosystem, right? To the extent that you really need these machines in the same room as each other, right? The instantaneous communication between these devices is so critical that you need them co-located, right, in the same data center. And a lot of people hear decentralized and they immediately assume that means distributed, right? That means that like all of the equipment can't be adjacent to each other. But that's not always the case, right? So we have a large number of big co-located clusters within Aetheir, right? Because that's what's necessary for large training runs. Yeah, long story short, AI needs a certain type of compute. Certain customers need a certain type of compute, and we've built our network specifically to serve those customers.
Cool. And for Matthew, how does your permissionless approach affect pricing dynamics compared to traditional cloud providers?
Yeah, so the way we take this is kind of like a staggered approach, right? Initially, let's kind of build a network, ensure that there's sufficient supply and demand, and eventually build in some module that allows the free market effects to really take control of how we price compute on our network at OpenGradient. And this is tricky because we have what we call like a heterogeneous network, which means it's not just one type of node doing like the same type of work. We have GPUs providing compute. We have TEs as well, also CPUs. And depending on the specific requirements and demands for your compute, either it could be TEs generating computational attestations. It could be, GPUs generating ZK snarks in addition to running inference, or it could just be CPUs running inference on smaller classical machine learning models. The cost of compute really does vary between, all these different use cases. And kind of we want to build this like flexible module into our network that allows, supply and demand and, the varying kind of fluctuations in supply and demand to take effect and allow the network to, bring in more suppliers of GPUs and compute when demand is higher and vice versa. So that's kind of like our approach. Again, today we're more focused on ensuring that we're able to get traction and actual grounded real-world use cases of this compute within the Web3 ecosystem, and then gradually focusing on optimizing for cost.
And Mathilda, I do want to hear from you, but real quick, what are those tangible, real use cases that you're seeing today? Because I feel like sometimes in Web3, it's a lot of talk, not always a lot of delivery, but you guys are delivering. So what is happening?
Yeah, I think that's a great question. Right now, like a lot of people, when they look at the crypto AI space, the most common thing we get is, crypto AI is just purely mimetic. You have these people building like AI agents that are tweeting, but realistically, they're not generating a ton of grounded value, so to speak. The kind of use cases we've looked at in terms of applied modeling are kind of, they're not entirely novel or new. They're kind of borrowed concepts from TradFi or Web2. And some examples include kind of building machine learning models to optimize AMM trading fees to help reduce net and permanent loss faced by liquidity providers. And the models that we built, which are all available on our AI model hub, show that we can, for pairs such as BTC, USDC, if you incorporate these models into AMM design, we can increase fee collection by 18%, which is like a staggering number. We were building risk models for lending protocols and CDP protocols. We're also building these spot forecasting models for vaults as well as prediction markets. So these are, again, very grounded machine learning use cases that have seen use in TradFi, especially coming from 2 Sigma. Like people build these models all the time, and we're simply building infrastructure that helps support such use cases.
Are you targeting more Web3 customers for your service than kind of Web2? I mean, we're very Web2 from a customer perspective. The vast majority of the revenue that comes through us is from Web 2 companies. You're more focused on kind of the Web 3 customer?
So the kind of approach we take is we don't necessarily, I guess, discriminate between Web 2 and Web 3. It's infrastructure that provides seamless and secure AI workflows. So Web 2 customers are free to, we have a Python SDK that allows developers to, abstract away the blockchain complexities and run secure AI workflows that generate snarks and attestations directly from their command line interface or from Python. So in this case, we cater to Web 2 as well. But I think presently, being very realistic today, if you look at, Web 2 AI demands and Web 3 AI demands, Web 3 has a much higher requirement for verifiability and security just due to the way blockchains work. They're replicated state machines, right? We need to ensure that every single node is able to verify some computational proof to really trust the results of the computation and use it in some protocol. So I guess long answer short, a lot of our customers are Web3 today, but we actually do have some Web2 customers we're talking to, notably in healthcare actually as well. So that's interesting to us.
Super cool. Mathilda, very curious about Gaib because I think compute is this new-ish asset class that I think will outcompete even oil maybe eventually. And you guys are pretty much creating I kind of see it as derivatives economy around her, real world assets that obviously can be traded in almost like the hyper financialization of compute as an asset class. Yeah. So how are you seeing the sort of inflows either from one, the interest from compute providers, but then two, the sort of demand side? Are these people primarily Wall Street traders? Are they just independent traders? Yeah, walk us through a bit more of the customer segment of Gaib.
Yeah, for sure. Great question, actually. Starting with the GPU side, right? The demand is already very big and it's growing bigger and bigger. A recent case is a deal between Blackstone and CoreWeave. CoreWeave is one of the biggest hyperscalers these days as well. So they collateralized a whole bunch of GPUs with Blackstone in their private credit fund and borrowed out $7.5 billion. Meanwhile, the investors in that private credit funds are enjoying roughly 15% of interest, which is quite attractive. However, these kind of deals, it takes a lot of, it takes time to process. It takes a lot of due diligence. You will have to be as big as CoreWeave in order to strike this kind of private credit deal with Blackstone. There is actually a lot of medium and smaller cloud and data centers that also have this kind of demand. They've got a whole pipeline of clients wanting to use their GPUs and they need capital to scale up their business. So that's what we're targeting at the beginning. We're targeting basically cloud and data centers that have roughly a few hundred million to a few billion AUM in terms of assets. They're the ones that would be bringing meaningful traction to us. They have pretty solid professional grade GPU to collateralize. Meanwhile, they are not necessarily being served by big asset managers like Blackstone's right now. So that's on the supply side. Right now, we've already got a pipeline of $1.8 billion worth of GPU assets, starting with our co-founder, Alex. He has a cloud company called GMI Cloud, which is serving Alibaba, Xiaomi. It's got a whole bunch of H100 and the procurement contract of H200 as well with NVIDIA. So we're starting with that. We're also in the middle of striking a deal with a data center in Thailand, some data centers in Taiwan, and in the US, in Japan as well. So I'd say the demand is actually very big. And on the supply, okay, I will say actually that's more on the supply side, on the demand side. On the capital side, I would say what we're targeting, essentially retail investors, crypto institutions, regardless or crypto whales. On the institution side, crypto funds, no matter venture funds, liquid funds, or family offices that have a crypto exposure, for them, the yield is quite attractive, right? Because if you go to the real world and you invest in a private credit fund, obviously you have to go through a lot of processes, and especially for retail, you can't really do that because you're not an accredited investor by these, defined by these funds. But you can participate and earn yield on chain. And for institutions, like especially crypto funds, they wouldn't have to worry about any kind of on-ramp and off-ramp, right? So because they can just immediately invest on chain. And by kind of eliminating a lot of intermediaries, we can bring the yield of our bond model, it's kind of like a bond for AI, to somewhere between 15 to 20%. And if it's an equity model, it could be like even more than like 40%. So it's quite attractive yield to them as well. We are already getting a lot of interest. Yeah, so I think we're pretty confident on the interest on both sides right now. It's just a matter of execution to actually like bringing all these deals on chain and like going through all of the legal processes and everything.
What is that missing part? Like we say bring those deals on chain, like what needs to actually happen? What does bring deals on chain mean?
Well, it's literally just like legal work, right? Because like, I mean, we obviously ride the AI wave and everything, but essentially we're also a bit more of an RWA play. And you know, like the most important factor in any RWA project is pretty much the regulatory, you know, aspects, the legal setup and everything. So essentially, we need to like talk to all of these like data centers, and we'll fly around, and to meet them like in real life, not online, and then like. Really sit down and flesh out all the details of these deals. We need to sign agreement with them, and we need to make sure that legally speaking, like for example, if it's a loan structure, they will pay us the interest, and then we'll distribute the interest on chain, for example, to all of the investors. So it's really just like signing these deals, yeah.
In many ways as well, because we're quite close with the Gaib ecosystem. In many ways, it's also having the infrastructure on chain too, right? Because you're building these investment structures that are tied to these GPUs, right? So ideally, you want those GPUs on chain too, right? You want the ability for that kind of investment contract to be linked to the infrastructure on chain. Just, I guess, from a transparency perspective, from a connectivity perspective. But yeah, I think it's for me, it's exciting. Just the opportunity that it provides for the average kind of non-sophisticated, more retail investor.
Yeah, I mean, it's interesting to me. I think the real-world asset world has been around for quite a while. And I think the main blocker has been regulation and regulatory clarity. And so I guess I'm kind of curious, Mark, like, are you concerned at all about these things maybe even be defined as a security? And has this, you know, is this actually a concern? Because I'm close with like the SF compute team, and they're like a big kind of Web 2 compute provider, and they're jumping through so many hoops to try to get regulated properly. And it's been taking them years and years and years. And then I see all these like decentralized solutions kind of launch much more quickly. And I'm curious, I asked them like, why don't you just do the Web3 thing? And they're like, yeah, we're trying to, you know, get listed on the CME. And so I guess, is this a concern?
Which piece? Which piece?
I guess like the tokenizing, and then from there, like, are you able to like whitelist, blacklist in order to like prevent any sort of like misuse of compute?
I mean, yeah, I think compute is semi-regulated.
It's
right?
geopolitically incredibly sensitive.
Exactly.
Yeah.
Right. Semi-regulated, geopolitically very relevant. We, for example, have to gate compute coming from certain regions, right? So, for example, H100s, so like current flagship, or maybe, you know, H200s are out there now, but you call it flagship GPU from NVIDIA, right? Shouldn't be in China, right? Shouldn't be there. But we have had compute try to onboard from China, right? And we need to be really cognizant that if we were to accept that onto our network, that would be, you know, a potential liability. So that's the challenge with permissionless ecosystems, right? You want true decentralization, you want permissionless networks, but at the same time, there's a risk there that we need to manage.
You were just talking about this. Go ahead, please.
Yeah, I was just gonna say, like you bring up like the idea of securitization, and like coming from TradFi, like we use this thing called the Howey test to determine whether something's a security or not. I think the risk of regulation for compute, like I guess like GPUs in this case, being a security is relatively low, just because there's not like one unified enterprise, which is like one of the principles of the Howey test, and the other one I think is like investment, or you're expecting some kind of profit, which I think is maybe a thing, but there's no shared enterprise, right? So I think it would probably be classified more as a commodity, if anything.
I agree.
Yeah, similar to gold or these other like precious metals and typical commodities that CME traders might bid on. But I do agree, like kind of to your point, right now these powerful GPUs are, everyone's looking at them, especially since we don't want them to fall into our political opponents' hands, and I think there is a whole can of worms you can unpack there. But yeah, I just like wouldn't really classify them as securities today.
I mean, we only have about 30 seconds left, but Matthew, real quick, the intersection between compute and agents. Like I see these agents actually eventually purchasing compute themselves, training other agents via this compute. I guess all of you really are focused like doing this. Quickly, what do you think the future of this intersection looks like?
So I think permissionless compute or permissionlessness in general is just like powerful for agents, because it gives agents a lot of agency to do more things. In this case, right, like you might imagine once agents get to the point where they're able to actually make sense of data and figure out how to train their own models, they can deploy their own agents and really gain a lot of sovereignty, autonomy, and agency by deploying agents that they can have do other things on their behalf. That's like something that we're particularly excited about. Just like to throw in something that we're working on. So we have, it's not so much an agent deploying another agent, but we have this agent project we're working on where the agent is actually able to query other machine learning models that can help it, inform it. For instance, in this case, we're able to have the agent query a spot forecasting model that can give the agent some idea and notion of what assets might appreciate based on that machine learning model. And that's able to allow the agent to make much more precise and accurate decisions in terms of what to buy. And this is like a powerful use case of how composability and permissionless compute can really make agents, or can get agents to the next level.
It's going to be wild. I wish we had more time. Feel free to find us in the back after. Thank you for having us.
Thank you.
Thank you.